All right, guys. Welcome to class. Welcome to class. I am here with your boy Armani and your favorite, or your second favorite, Miss B. Okay, no, I'm just kidding. We all know she's your favorite. All right, so guys, listen. I'm recording this because a lot of you aren't here today, and this is something that needs to happen today. I gotta give you this lesson today. So if you weren't in class, it's all good. You got a chance. You can watch the video and still learn everything, okay? So you guys know lately we've been talking a lot about investing, or rather, we've been talking a lot about saving. Right now, we're going to talk about investing, different ways that you can make money, right? Some of the concepts that I really want you to understand and focus on, especially now that it comes to stocks, right, and investing, is how do we assess risk versus reward? Is it worth it buying in at this price and selling at that price? Things of that nature, right? How does supply and demand affect stocks? Higher the supply, the less the demand. The higher the demand, usually the lower the supply. Okay? What is the difference, again, between saving and investing? We talked about saving. You got those for sure interest rates from banks. When you invest, you could get even higher interest rates, to be honest with you guys, okay? But it's a little different because it's not guaranteed and it's not for sure. Again, this comes back to assessing that risk versus reward, right? So the stock market, oh, what's up, JJ? Good morning. Ms. B, you want to just message JJ real quick, let him know what I'm doing, and I'll just continue our video. Um, let's see. So, guys, stock market, right? It can affect a lot of things that you see every single day on an everyday basis. Starting with what houses we can afford or we can't. Where the job market's going. Is it growing? Is it declining? What products are available to us? Things of that nature, okay? So, what is a stock? Okay, a stock is basically a piece of paper, right? Real or virtual. Nowadays, it's all virtual pretty much, that represents ownership in a company. Okay, so if I have stock in Apple, I have ownership in that company. It may not be a lot of ownership depending on how many shares of stock I have. It could be a very low amount of ownership, but regardless, it's still ownership. That company goes up, I make more money. If they go down, I lose money. Okay. Um, Now think about this: if a company has 100 total shares of stock, right? Which is usually not the case. Usually companies have billions and millions of stock. It's usually never 100 total shares, okay? Then each share of stock would represent 1% of that company, right? Now, if you own 10 shares of this company, you would have 10% of that company, okay? But that's not always the case, right? Please remember that. Now, my question for you is, if a company has 260 total shares of stock, and you own 25% of that company, right? How many total shares of stock do you have? I'm going to pause the video and let you figure that out. All right, so 25% of 260, you should have got 65. Okay? Now, why do companies sell stock? Why would I, if I owned a company, want to give you part of my company? Wouldn't I want the whole company? Yeah, but companies do sell stock. Why? Because they raise money. They make money, right? Every time you buy stock, you pay money for it. If you're paying money for stock in my company, that money goes to me, right? What can we do with the money as a company? We can buy different materials. We can create new products, buy new factories, pay our employees, right? So imagine if I had, you know, a company that made this simple little pen right here, which is actually a very nice shade of purple, if you ask me. Okay, but if I made this pen and then all of a sudden Miss B invests in my company and gives me $50,000, I might be able to start making some nicer pens. Instead of this little rubber grip, which isn't very grippy or rubbery, we might get the nice one, right? So that's why companies sell stock, right? In order, they raise money. Your question is, give me two reasons. You can pick any of these two reasons here, okay? Fellas, if you have any questions while I'm going, let me know and I'll pause the video, okay?
All right.
Now, why do people buy stock, right? So I'm a company, I'm selling you shares in my company because I'm trying to raise money. Why would you want to buy stock? Why would you want to do anything when it comes to that nature, right? Why? Now this is like the big money thing right here, guys. Why do people buy stock? People buy stock in companies to try to make more money. That's it. That's like as simple as that.
Yeah, I was about to say that to sell it.
Yeah, literally to make more money. That's it. That's the only reason. There's no, people might want power and influence and blah blah blah, but at the end of the day, it always comes down to the money, right? That's what they're trying to do when they buy stock. Okay, so you remember how before we were talking about saving money in a bank? Now you're basically letting the company borrow your money, and in return, they're paying you interest, right? But remember, this interest is different. It could be really high. It could be very low. It could be negative. It's variable. It's volatile is the word that they use, right? So again, remember, the company does well, the price of your stock increases. The company does not do well, you guessed it, your money goes down. Okay? Again, why do people buy stock? To try to make more money, right? It's not rocket science. At least that part. So now, where does all this stuff happen? Like where are people selling stock, people making money, buying stock, all that? All of this happens on a stock market. Okay? Your takeaway question is, what is the stock market? Right? The stock market is a place for investors to buy and sell shares in companies. Okay? That's that's what it is. The stock market usually, guys, it serves as an indicator as the health of the economy, okay? So usually people will be like, hey man, the economy's doing great, the stock market's booming. Like that's what everybody says, right? That means things are doing well. People are comfortable, like, putting their money out, as a risk and blah, 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 right? So this whole concept of sharing ownership, I want you guys to know, now this is actually the cool takeaway right here. It can be traced back to 1604 to the East India Company, which later actually, which I'm not going to get into, to be honest with you right now, but this also has to do with the East India slave trade, okay? Which is how people from India ended up in Trinidad, and people from Africa ended up in America. By people, I mean slaves, okay? But that's something that is another topic for another day. I want to talk to you about the East India Company and how they started the concept of sharing ownership. Now, imagine, so back in the day, guys, I couldn't go onto Amazon. I couldn't go to the bodega down the street or to Target or to Stop and Shop or to Market Basket to get everything I needed, right? People had to trade. People had to trade, and also everything wasn't available in one place, right? So if I lived in India, Amani lives in Europe, and JJ lives in South America, there was certain stuff that only JJ could access in South America, and only Armani had access to in Europe, me in India, right? So basically what would happen is from India, they would, from, the East India Company, they would have these big, giant, massive ships, right? And they put a whole bunch of stuff on it that was only in India. And then we'd go to Armani in Europe, we'd be like, hey, Armani, here's that stuff you wanted, blah, 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 blah. Now, where's the stuff that I needed or I wanted, right? And then we would trade that, or he'd give me coins or something, whatever, right? And then I'd go on to JJ and vice versa. But you guys got to remember, this is back in the day, 1604. That was a long time ago, right? Everything wasn't so technologically advanced. Things, like, for example, like the ship could get lost at sea. Something could happen, and then that's it. Everything's wiped out, right? So I'm the businessman. I'm the owner of the ships, right? I'm like, yo, man, I got to send out this ship. It's like cost $100 million. At the time, it definitely did not cost $100 million, okay? But dude, but this $100 million, when it comes back, I can make $200 million. Definitely worth it, right? Okay, but what if I lose everything, yo? I can't afford to lose $100 million. So you know what I did was I went to you guys and I'd be like, hey, Miss B, Monty, JJ, can you please listen? How about we do this? How about we each put in $25 million? Okay, but listen, if everything goes well, though, I'm gonna give you back $50 million. Okay, so that way for me it's less reward, but it's also less risk. Okay, so we shared in the risk and we also shared in the reward. All right. Now, some quick background on the stock market. I'm going to just go through this real quick. In the U.S., most of the trading takes place on three main exchanges: the New York Stock Exchange, the NASDAQ, and the American Stock Exchange, right? I want you to think about the stock market like this. Now, fellas, if you have any questions, please ask, all right? Because I want to make sure you get this. Now, I want you to think of the stock market like a grove of fruit trees, okay? The trees rely on their numbers to thrive, but the survival of the forest doesn't necessarily rely on just one tree. So if you got a bunch of apple trees, that's good for the whole forest, but it doesn't necessarily mean that the orange trees are going to do well, right? So this kind of goes into remember, Supply, demand, supply, demand. Okay? Now, guys, I got a meeting, I realized, at 9:55, so I'm going to get through this real quick. Give me 1 sec, all right? How stock prices are determined. Now, please remember, how is the value of a stock price determined? That's the $1 million question for you, right? But don't answer it just yet, okay? Just think about this. Their stock prices are determined right now, right, by the revenue growth. How's the company doing? Is it climbing? Is it falling? How is the management? Right? Imagine if the person leading the company is just some dude that you can't rock with. You're like, yo, this person is not a good person. I've heard this, I've heard that. You're not gonna feel comfortable investing in that company, right? But what I want you to know is that no one actually sets a stock's price. Earlier, when we were talking about Nike stock prices and Apple stock prices, right? Nike was at like 130, 135. Nobody actually set that, okay? How it gets set is how investors handle them. If all of us went and started buying Nike stock right now, it would start to go up. If we all started to sell our shares of Nike stock, it would start to go down, okay? Remember, higher demand equals higher stock price. Lower demand equals lower stock price, okay? Supply versus demand, supply, demand. Okay, if everybody wants the apple trees in the forest, those apple seeds are going to get a lot more expensive than the orange seeds. You can definitely bet that, okay? So that's how the stocks kind of work. When you guys come back, we'll get a chance to get into the nitty gritty, and you're actually going to get a chance to buy some stocks of your own. You're going to get $100,000 of basically play money, and it's going to be awesome. You guys are going to love it. You get a chance to compete, and then whoever finishes 1 through 5 out of all of our 9th grade classes is going to get a chance to get some prizes. All right?